Hello, good evening, everyone. Hope everybody's doing well. Just making a few adjustments here. My name is Mel. Welcome to Team U Finance. And for today, we are continuing with our credit series. The name of today's series is basically Credit 101, and we're talking about the Big Five. And the Big Five is basically what makes up your credit report. Okay? The Big Five is how the credit bureaus give you a score, right? The things that make it up. So I'm just going to wait a few more minutes and see, how much people join me, who's on the live. If not, I'll just, continue talking about the Big Five. Okay. So just to start, I guess I could retouch when someone decides, to get on, but let's start. So we all know that credit is a tool. And when I say that it's a tool, credit is a financial tool. And the first step in changing anything or gaining any type of financial freedom is to have a tool or something that allows us to build wealth. So the first thing that we have to do to start to try to build wealth, if you're not at that level, is we have to clean up our credit. So for today's live, again, as I said, I want to talk about that financial tool and how that tool is used to basically clean up your finances or clean up your credit profile. So I'm going to be giving you the 5 things that basically make up your credit profile, the 5 things that comprise your score, the 5 things that give you that credit report card. Okay? So let's see. The first thing that we want to start, and I always make a list because I don't want to shortchange you and miss anything out, so we could discuss each of them. So we're gonna break down what each of these things consist of. So let's talk about the Big Five. All right, the first one that we want to talk about is our payment history, and for each of these histories I'm going to give you the percentage of what it comprises. So for your payment history, you need to have at least, not at least, but your payments need to be on time. So your payment history makes up 35% of your credit profile. Again, that's 35%. So let's talk about how the payment history works. All right. Good evening, Starlight. Thank you for joining. If you're just coming on, hi, Omid. Thank you for joining. If you're just coming on today, we're talking about Credit 101. And we're talking about how you can, basically use credit as a tool to financial freedom. So for those of you that are just joining, the first thing that I'm going to touch on of the Big Five, and again, this is the Big Five in credit, the 5 things that make up your credit profile. So the first thing that I have is your payment history. Now, when you have your payment history is 35% of your credit profile. What does a payment history means? Payment history is basically, when lenders look at how you pay your bills. Do you pay on time? Every month when you have, have your bills due, you're supposed to pay it on time. The credit card companies or your loan give you enough time to pay it. Okay? So when you have enough time to look at your payments, they want to make sure that you send your money in on time, and that's your payment history. So with that is basically talking about if you're paying on time. Okay? It's talking about if your payment history is on time. That's 35% of it. Because again, when lenders see that you're able to pay your bills on time, they're more likely to trust you and to give you loans or to give you credit cards. Right. They don't like any type of lapses in anything. They don't like late payments. They don't like delayed payments. They just want you to pay your bills on time. So that's the first one of the Big Five. Okay. The second one of the Big Five is your credit utilization. Now, this one I love. And why it's so important, because a lot of people think that when they, have a credit card, that they could just use it, like they use all of it. For example, let's say you have a new credit card and the bank gives you $1,000 for your credit limit. Although you have $1,000, which you are allowed to use and you can use for your credit, they don't really want you using the whole $1,000. They want you to utilize a certain amount. They want you to be under a certain percentage. So for your credit utilization, when you have a card, they're looking for you to utilize 30% on your credit card. Okay, 30% is the most they're looking to use. Now, some people might come back and say, well, you know what, although they said I could use 30%, um, why not try, or why not, use a lower percentage? Because when you use a certain amount, this is what helps your credit score to revolve. So with the 30%, it's basically how much you spend versus, your limit. All right. So I always give the number. Let's say you have, hi, cool kid, 111. Thank you for joining. Really good to see you. Thank you so much. Right. Okay. Thank you, Kobe. Good to see you. So for your utilization, as I said, it's only going to be 30%. So for example, let's say you have $1,000. Now, what's 30% of $1,000? 30% of $1,000 is basically $300. That is on or about how much you are supposed to spend, about the amount that they want you to spend. Now, are you going to just spend the 30%? I mean, people have situations, people have emergencies, so they might end up spending more money. But here's the kicker. If you spend more than the 30%, it would be advisable for you to basically pay more. Okay? So yesterday I was doing a live, and a gentleman was saying that when he, uses his credit card, he tries to stay under, he tries to go like 10% of it. And even if he uses more, the gentleman says, listen, I pay it right away. I paid it literally every week. Or if I go in a store and let's say I spend more than the 30% that they want me to utilize, what I do is I literally pay the money. I pay it back in cash, but I use my credit cards to basically revolve it, to show the lenders that you know how to manage money. So that is number 2 of the big 5. It's your credit utilization. All right. They only want you to spend basically 30% of what your credit limit is. All right. So that's pretty good. Now, the other thing that they look up at the big 5, number 3, they look at the length of your credit history. Your credit history is basically how long you've had your accounts. How long, what's basically the age of your accounts. So let's give some examples. Let's say, for example, you go to buy a car. And I always use the car because a lot of people, that's when credit really counts for a lot of people. Let's say you go to buy a car. They're looking at how long you've been revolving credit, how many trade lines have been on that credit account for how many years. So the longer credit history that you have, where you have like stable accounts, stable trade lines, whether it be a loan, anything like that, a stable credit history being reported, this is when they look at you as having a good credit history. Okay, you have a lot of age on your credit, right? So if you've had your credit for a while, or your credit history for a while, and you're not you're not having any delinquencies on your credit, everything is moving along, it's going to be much easier for you to qualify, because again, it shows that you can be trusted, and it also shows that you know how to manage your money. That is the length of a credit history. All right. So far we've talked about 3 for the big 5 for credit. And again, this is credit 101. We talked about a payment history, and we said that our payment history should be at least 35%. Okay. 30 of 100%, 35% of your credit profile is your payment history. All right. The second 30% is going to be your credit utilization. Basically, how you're using that credit card. All right. If you have $1,000, are you using the whole $1,000? Are you using $600? And then when you get your bill, you're literally just paying the minimum. And speaking of the minimum, I want to talk about that. Now, a lot of people can only afford to pay the minimum back. But if you have a credit card and you utilize more than that 30%, and you find that you can definitely pay some more back, why not? It's only going to help you more, and it's only going to boost your score. And again, it's going to show the lender, or that credit card company, even the credit bureaus, that you knew how to pay back and you knew how to manage your money. So it is definitely good to pay it on time and utilize either lower. And if you end up utilizing more, you understand, you're encouraged to pay it back. All right, so those are the 3. We also talked about the credit history, talked about the age of the credit. All right, your credit history makes it makes sense. A lot of people like to, not people, but a lot of lenders like to look that you have a history. They want to know that you've been able to manage your money for a long time. Okay, they want to make sure that, if they lend money to you, that you're going to be paying it back on time. They have days, or they have time limits that they set for you to pay it back. Now, generally, if you have a credit card and you take more out, you end up basically paying, I think, every 30 days your bill is due, whatever it is. And when your bill is due, they'll show you like the annual percentage rate that they're making on it. So again, if you have the money, you can do it. Why not just pay? Thank you, Alkaline. Thank you. Why not just pay more than you can? It's only going to help you. It's only going to let your credit profile grow more. All right, perfect. So those are the three things. Now, let's talk about the credit mix. We all know what a mix is. A mix is a bunch of things comprised together. So, although I told you that I'm going to be giving you 5 things of the big 5 that makes up your credit profile, in the middle of that is your credit mix. Can anybody tell me like what they think the mix would be, or how, you take it as somebody says, let's see how your credit mix is? Okay. So your credit mix is basically all the things that are on your credit, all the mixes of different things. All right. Your credit mix can be your credit cards. It could be a mixture of your loans. It could be a mixture of like utility accounts that are reported, because now a lot of companies report utility accounts also. Many years ago, or gone are days where it was just strictly credit cards and loans. Now people are actually, or now companies are actually reporting how you pay your utility bills. I mentioned in previous lives that, if you needed like a mix, you need like a trade line. I talked about Kickoff having that great trade line and allowing you to put different things, and there's different rates that you could start. Again, when you can show a lender that you have different mixes or different accounts that you can manage wisely, you can manage well financially, they'll say, okay, this person knows exactly what they're doing. Okay. So that's how you end up with having a mix on your credit. So some things to mix with. You can mix with credit cards. You can mix with a car / your auto. You can mix with utility bills. If you are a homeowner, you could, show reporting of your mortgage. And again, they also have mixes if you rent. You have places that literally report to the credit bureaus when you pay your rent on time. They allow you to mix any and everything, basically, to get those scores up. Because at the end of the day, when you go and try to qualify for anything, whoever's going to lend you the money wants to know that you've had trade lines and you've had accounts revolving on your credit. You've shown some stability. This is not really a society where they just take cash all the time. Like a lot of places don't even want cash. They want everything in credit, or they want you to qualify for things. Now, the secret to why they wanted to do it, I have no idea. But from where we live, doesn't really matter where you are. Everything is a credit-run society. All right? Everything is credit. So you end up building your credit better when you have a mix of things on your credit profile. And, credit is not something where I feel like you literally have a choice. Because anything that you want to buy, as long as you have credit established, it makes you qualify for those things more. It's easier for you to qualify. But if you don't have credit, you're not going to easily qualify for those items or for those things that you want to buy. And on the live that I was at last night, I was talking about, qualifying for a mortgage, having credit and being able to qualify for a mortgage. That was like the hardest thing that a lot of people have to do. Okay. I talked about a lady that ended up, having to get a few trade lines, basically get on somebody's credit card as an authorized user because her credit score was really, really low. And when I say low, she was literally in the 500. So she had to basically get on somebody's card so they could, whenever their payment reports with her social security number, it was being reported for her also to boost her credit score. So those are just some of the ways that you can basically mix your credit with different type of loans or different type of trade line accounts that are reporting positive to the bureaus. All right. The 5th one of the big 5 is basically new credit. Lenders like to see how you manage, credit. They want to see how many times have you applied for credit within a certain amount of time. So they call these things inquiries. All right? Inquiries on your credit. How many times did you ask a lender to inquire about giving you credit? How much times did you inquire from a lender to get credit? How many times in the past month or in the last year or the last couple of years? Okay? So inquiries stay on your credit report for a little while. Maybe, I think it's like up to a year inquiries stay on. And then after a while, they start to drop off. They don't like when you have too much inquiries. There's times that if you apply and you have a certain amount of inquiries, that could basically allow a lender to deny you, because they're saying basically, like, what they're saying is like, you're too thirsty, you're too hungry for credit. That's what they're saying. Sorry, I was at to take my water breaks. They're saying that you're too hungry, you're too thirsty for credit. And because you're too hungry, you're too thirsty for credit, they don't think that you're going to be a good candidate for credit. Now, for somebody that's in a hard situation and need credit, and they ended up having to have to apply for credit, and they have a few inquiries, there's nothing that you can really do. So let's talk about some places or companies that are allowed, or basically gives you a lot of inquiries. One place or one thing that you apply for, whenever you apply for, a car loan, you end up with so much inquiries on your credit. Because when you go to that dealership or wherever let's say it's a dealership, it's not really a private sale. But if you go to a dealership and they end up buying, you end up buying a car, for you to qualify for that loan, they're going to run your credit profile to a lot of different loan companies. And so those loan companies basically have to view your credit profile. You might go apply for one auto loan and you end up with literally like 50 to 100 50 inquiries, not 100, up to 50 inquiries. This could be days that they're basically running your credit profile. Or if you went to one dealership and it didn't work out, the other dealership would have to run your credit profile. They would have to see what is going on, with your credit before they qualify you. And I've heard of situations where if you went to one dealership and they ran your credit profile and they didn't like what they saw, you couldn't just go into another dealership the next day and just apply. It's like they put a limit on the time because, again, I think it probably hurts your credit profile. So those are just some of the 5 factors, the big 5 as I call it, that make up 100% of your credit profile. So again, we had 35% of your payment history. And for that payment history, we're just looking at paying your cards or paying your bills on time. That's it. It's like, for example, let's talk about another form of credit. Like if you rent, you know that every month, the first of the month, your rent is due with a grace period. When you have credit cards or you have loans, that's another thing I want to touch on. They also give you grace periods. So if something is due, let's say the 5th of the month, each company is different. They have the amount of time that they allot for grace or for time for you to get it together or for you to pay. Everybody has a situation that arises, but for sure, you want to make sure that those payments are on time. You want to make sure that they're coming in. If, I always tell people that if, in cleaning up your credit, if you are trying to get your payment history up and if you find that you're running behind on your payments, don't just sit there and let it default. Don't just sit there and basically say, okay, you know what, I'm not going to pay it because I don't have it. You got to talk to the lender, because at the end of the day, that 35% payment history is going to make a difference in you qualifying. Okay. Another thing I want to talk about when you don't pay on time with your payment history. Now, if you look on your credit reports, you'll see, if you look on your credit reports, you will see, 30 days, you'll see 60 days, you'll see 90 days, and so forth. You see all of those different, numbers. Now, the first thing is when you're 30 days late, right? You don't want that, because sometimes if it's like 30 days late, it could definitely like drench your score. Okay? It could basically tank your score. That's what a 30-day late does. Then sometimes you have a 60-day late. It's going to go down more. After the 60-day late, if you end up with you have 90 days also, and you also have, You also have 120. And when it gets to be 120, that's when you could definitely I'm sorry, I just have to take somebody off the slide that's being rude. Excuse me. Thank you so much for your patience. All right. Right. So what I was saying, that you don't want your card or your payment history to show that you made your payments 30 days late, or you made your payments 60 days late, 90 days late, or 120 days late. Now, let's talk about that 120 days. When you have those 120 days, 120-day late, okay? Um that's when lenders start to charge off, okay? But then every lender is different. They go into review. Again, I always advise people, get in touch with your lender or your credit card company, see what you can work out. Most times those credit card companies have programs, or they have, arrangements that you can make so you don't default on your credit card payments or your loans. It's like you don't have to go down that road where you don't make your payments, because you don't want to end up with like low payments or bad payments. All right? That's the big thing about the payment history. The payment history is literally, if you notice, it's the biggest one, because the payment history is 35%. The credit utilization is 30. The length of the credit history is 15%. The credit mix is 10%, and the new credit is another 10%. So that makes up the 100, right? So if you notice, the biggest one on this that we could take away from this, the basics of this, is that the payment history is the biggest thing. Showing a lender that you knew how to pay your bill, or you pay your bills on time, is that the biggest part of your credit profile. And this is why we have to work and ensure that we're paying as much as we can in our credit. We're paying our credit down. We're paying for our credit cards. We're not just leaving our loans and our credit cards to default. Right. And they report those things. All right. Many a times when you default on your credit cards, what is it, 7 years that it stays on your credit for? And a lot of things go to the statute of limitations depending on your state. Again, credit is, I don't want to say it's a case by case basis, but like, God forbid you default on your credit or your credit score goes down. Every lender, every credit card company, every loan company, they take different ways and different measures to get their money back. Some might decide that, okay, hi, hi, cool kid, thank you for joining. Some might decide that, listen, they want to take legal action, or they just might, let it charge up, or they sell the debt. So again, you don't want those things to be in your credit report where you're not making your payments on time. For those people that are able to make their payments on time, good for you. It's only building your credit history much higher. All right. It's only making not credit history, your payment history much higher. As far as utilization, as I said, although they say 30%, when I use my cards, I don't even like to go over 10%. I don't. And if I ended up where I have to go over 10%, I try to pay it off as soon as possible. And the reason why, I'm not paying it off as soon as possible because, I obviously had the extra money. I just pay it off because I don't want it to stretch out. Because when you let those payments linger on for a long time, you end up with a really high interest rate. Okay? You end up with a really high interest rate. Interest is basically extending on your credit profile. It's like the bank is making a lot of interest when you could have paid it off. Credit is wonderful. Credit is beautiful. But credit is not supposed to end up costing you more than what you borrowed. You get what I'm saying? If you have a credit card where it's $1,000 you borrowed, and you wait, like, let's say 5 years or even 10 years to pay it off, that $1,000 that you initially got from the bank, that ended up costing you maybe $5,000 in a few years, depending on the interest rate that you get. Okay? So that's why it's so important. It's so imperative that everyone tries their best to pay it on time. Everybody should try to utilize the least that they can with the credit cards. Again, credit is basically a privilege. It's for emergencies. I would tell anyone, in terms of the length of the credit history, if you are having a hard time establishing credit, get you a secured credit card. Get a secured credit card. A secured credit card, unless there's something really egregious written about you on your credit profile, it should not be difficult for you to get you a secured credit card. And again, I'm going to touch on exactly what a secured credit card is. A secured credit card is a card that you fund. Or if you don't fund all of it, sometimes a lender will even fund some of the secured credit card for you. All right. It's so you're securing it. So when you're securing it, you're the one that's putting the money up front. So when you apply for the credit card, and let's say you haven't built credit or you're trying to rebuild your credit, if you haven't, if you haven't been able to get credit from the lender itself, you're going to basically bring the money. So with the secure credit card, they might ask you, they might say to you, listen, okay, if you put down, and I'm just throwing numbers out there, if you put down like $500, right? Or some companies even allow you to put down 200, depending where you start. Now, for like a student or somebody who's rebuilding their credit profile, if you put down anywhere from $200 to $500, basically you use it, you stay under the 30% utilization, like we said, and once you use it, standard utilization, you pay it back every month. Here is the beautiful thing with the secured credit card. Now, with the secured credit card, you end up, graduating or getting that money back after a year. Again, this is like your credit profile is basically, your credit report is basically a report card that the lenders look at to see how you did. So when you end up getting that secured credit card, they're going to watch you for like a year. They're going to watch and see exactly what you did, or they're going to watch and see exactly how you spent that money for that year. And even though you're the one that funded it, they're still going to try to see exactly how you spent it. So what I always tell people with secured credit cards, I don't care if you get a cup of coffee, use your card, right? Cup of coffee. Let's say you're spending your $5 on a, $3 to $5 on a cup of coffee, depending if you get small, medium, or large. Once you use it, you spend it, you pay it back right away. Build your payment history with that secured credit card. All right? Try to, even though you're the one that funded that secured credit card and it's your money, try to keep the utilization low. Okay? Spend the 30% that they advise you to spend. If you can't stay up below 30%, okay, whatever you spent, try to pay it off right away each month and build the history. Again, I had a gentleman that was saying that because he would spend his credit card, once he would spend the credit card and pay it back right away, he ended up getting his score literally in 3 months. His score just shot up. It just kept going up and up and up. Because remember, it's every 30 days that it's reported to the credit bureaus, right? So every 30 days, provided that your payment is good, your score is going up. The same way your score can go down if it's not being reported properly is the same exact way your score can also go up. It's literally the same thing. It's like you understand what I'm saying? It's like you have to do the things to allow them to elevate your score. So how is your score elevated? When you make your payments on time. Another great way to get your credit score up is by basically, paying more than they require you to pay. So if the minimum, I'm just going to number, if the minimum is $28, why not pay $30? Let's say you have $1,000 credit card and you spent the $300 and they came back and said, you know what? The minimum payment is like, I don't know, maybe $28, $25. I guess they have their firm to come up with it. Listen, if I can afford to pay more than the $20 or the $25, I'm paying more. I'm definitely paying more, because when I pay more, it allows me to basically build my payment history and it's keeping my utilization lower. All right. I'm not having it out there where it's taken forever for me to basically, pay off that credit card. The longer you keep the credit card out there is the longer it's the longer you have to pay back, and the lender's making more money. For the lender, that's great. They're in the business of making money. You're in the business of borrowing money. They're in the business of making money. But when you borrow money, you need to borrow the money wisely. You need to pay the money back. You need to have it lingering on and let interest keep accruing day in and day out. It doesn't really make any sense. All right. So that is exactly how we utilize our credit. We keep it at 30% or lower if we can and pay back right away. I also want to touch that for the credit history. Another great way to build, your credit history is basically being an authorized user on somebody's credit card. Now, let me explain to you what I mean by that. And I've talked about authorized user credit cards because they're so important. Because the hardest thing is that a lot of people really don't know how to establish credit. A lot of people don't understand that credit is a tool that we use to get financial freedom. Credit is a tool that we use to buy things. Like a lot of things in life are tools, and if you don't know how to use those tools, it's going to be very difficult. You're going to end up getting bad rates. You're going to end up paying more for things than you should have because you simply didn't understand how to utilize something. In this age of technology that we live, everybody knows how to use their phone, everybody knows how to use their electronics, but do a lot of people really know how to use their credit, how to use it as an asset? Your credit is it's an asset to you. It is something that you could use to build wealth over time if it's good. You should not only be worrying about your credit only when you need to buy something. Hence, you need to keep your payment history or your credit history good. So when you're finally ready to make that big purchase, you're not sweating and putting and feeling like your back is against the wall because you don't have good credit. All right. So how will the authorized user help you now with the length of your credit history? First of all, again, let's define what an authorized user is. An authorized user is somebody that's allowed on a person's credit card. Okay? So let's say they have, okay, let's say, I'll give it up. John has a credit card that he's had for years. John pays his bills on time, he pays them well. His credit score is through the roof. His debt to income ratio is perfect. John is a good candidate to be an authorized user on their credit card. All right. Now, let's say, for example, if some people might say, well, I don't have anybody to ask to be an authorized user on their credit card. And again, an authorized user on a credit card is just someone that allows you to be on their credit card where they literally authorize you to use the card. And when you're authorized to use the card, they basically authorize you to get the payment history, the good payment history that they have. Question is, how do you get an authorized user credit card? Now, for me personally, if I'm an authorized user on somebody's credit card, I don't need to have the credit card. All that I really want for them is to report their good payment history. Their payment history is what's going to help me to elevate my credit score and show that I'm paying on time. So you get an authorized user credit card from somebody that you're close to or somebody that you could, tell what's going on, that you're trying to establish credit. So for example, I had somebody ask me before, they said, well, I don't know anybody. I don't really want anybody in my business. Okay. I don't know. There's got to be somebody that you can trust, that you could basically ask to be an authorized user on their credit card. The only thing that the person's going to ask you for, again, is just your social, because remember, they're going to call the credit card company and they're going to give them the social. An authorized user, it's kind of like a co-signer for a credit card. But the only difference is that you who's going to be the authorized user on the credit card, you're not like putting anything down. You're just taking a chance in hoping that whoever you ask to be the authorized user on the credit card, that their payment history is reporting you as being good. That's all. And it's something that you can easily remove. Now, for example, let's say again, you're in the market where you're trying to buy a home, and you're at a certain credit score. And remember, you getting a mortgage is dependent on what your credit score is, the type of mortgage that you can do. The live that I did yesterday, we talked about the different types of loan that are based on your credit. And just to retouch, I said there were three. I said there was the conventional, where it's based on if you're in the higher 600s with the credit, up to even 800. You have so much more buying power. Conventional loans, they're for people that have a really strong credit history, like phenomenal credit, and for people that have a really great, income, good financial backing. So they can afford to put anything down from the 5 to, up to 20%, whatever they want to put down. Then I touched on the FHA loans, where these are loans that are government backed. And if you had a lower credit score, you could still get a loan. But just know that when you have a lower credit score and you qualify for the loan, you're going to end up paying something called PMI, private mortgage insurance. Those are the things that you're going to end up doing, again, because your credit is lower. So it would behoove you to, as I was saying before, get on somebody's credit card, and that allows you to be an authorized user. The only thing that you're worried about or concerned about is that the person that you ask, and hopefully if it's like a family member that you trust or somebody, your significant other, I would trust that they would, keep paying their bills on time. Again, if, for example, like let's say I'm a student and I'm trying to establish credit, when you try to get that first credit card as a student or as just a give it to you. So for example, if I'm a student and I'm trying to, build my credit profile, like I'm in college, I'm trying to build my credit profile. If one of my parents have good credit, I'm getting on their credit card. I'm asking them to be an authorized user. Remember, as I said, you don't need the credit card. You don't have to have the credit card in your hands. As a matter of fact, I don't even want one ordered for me. And even if they order one and the bank sends one, right, whoever it is that you got on their card as an authorized user, they're the one that's going to keep the card anyway. You don't need it. But again, like let's say you're a student and it happens to be like one of your parents and you get on their credit card or it's a relative and they said, "Okay, here, I'm going to give you a credit card for you to use it each month." There's nothing wrong with that. It's an asset to you. You're the one that's building up your credit profile. So, there's pros and cons to everything. The pro, I'm not the pro, the plus is that your credit profile is being built up. The con is like, I don't know, maybe you want the card and you can't get the card, you can't spend the card. But again, as long as my numbers and my score is going up, like the big five that I mentioned, as long as it's reporting payment history, timely payment history. It's reporting good utilization, less than 30%, minimum 10%, okay? If it's showing those things and my score is like literally climbing up, going up the ladder every month, if I wanted to buy something, maybe I wait 6 months as an authorized user. When I go back 6 months and listen, if I had my credit score, God forbid, let's say my credit was like in the low 500s, and I said, I'm going to give myself 6 months to get my score up to at least in the mid 600s so I could qualify and get a better rate. I'm going to do it. I just hope that I could find someone to make me an authorized user. And again, a lot of these things, they're not taught in school. A lot of people don't know that they could be authorized users. You don't have to be an adult to be, an authorized user on somebody's credit card. It could even be a kid. A lot of people don't know that you could put your kid on your credit card as an authorized user and say, well, small kids. Heck, if you got a 10-year-old, you could put your 10-year-old on your credit profile if you have a credit to be an authorized user. All you're really doing is just setting up your 10-year-old's or your younger child's profile at a certain time. You don't have to wait until you're like 20, 30, or 40 to build credit. Like, it doesn't work like that. Credit is something that needs to be built over time. That's why they call it payment history. They call it that because they watch your history. They watch you for a certain time to see how you've been spending your money, how you've been building your money up. That's exactly what they do. They want to see that you're actually spending your money at a certain amount of time and you're using your money wisely. You're not making bogus purchases. You're not buying things that are too high. You get what I'm saying? So this is where we jump into something called our debt to income ratio. When you qualify for any cards, and again, the credit cards is like the beginning. The credit card's a backbone. When you qualify, if you notice on every credit application, they're going to ask you, I'm sorry, a little thirsty. They're going to ask you what your income is. Now, I believe in my mind that they could easily check these things. They know. But again, they want to see what you're going to put to see how they can qualify. They're going to ask you what your income is. They ask you what your income is because they want to know what your debts are, your debt to income ratio, right? So let's say, for example, like I'm just throwing a number out there. Let's say, you're making, maybe a 10,000 a year salary. I'm just putting numbers out there. Okay. They're not going to give you a credit card if you're just making a 10,000 salary. They're not going to give you a credit card for $5,000. That's half of your salary. What if you end up maxing out that card? The lender is looking and saying, how are you going to pay that back? How are you going to do it? So what they're going to do is they're going to give you based on how much money you report, how much you tell them that you're earning, right? Once they know how much you're earning, they base the credit limit off of that, right? Sometimes you might apply for credit and you might just be able to get $500. Another person might get 1,000. Another person might get 2,000. Another person might get up to 5,000, even 20,000. It all depends on what you put down. Okay, that's how lenders gauge how much money that they're going to lend you. All right, that's how lenders gauge it. Right. So that's how you do it. Does anybody have any questions? Okay. Right. Does anybody have any questions? All right. Let's just quickly touch back on the new credit. A lot of people find it hard to apply for credit. So let's talk about some ways to get new credit other than the authorized user. Let's look at, building trade lines. That's a new way to get new credit. A lot of people start off by getting store cards, right? A lot of these cards nowadays are digital. I remember when I was trying to build credit, I always got that famous Macy's card. It was wonderful, right? And yeah, okay, cool, okay, thank you. Those cards are excellent for building credit, the store cards, because again, everybody likes to shop, and once you have the store cards that you build, they could basically see again how you're spending it, how you're evolving it. So that's a new way to get new credit. And funny enough, new credit is only 10%. New credit only makes up 10% of your profile. So lenders aren't really big on you getting a lot of credit because, as I said, with the inquiries, the new credit that you're trying to get, they don't really like when you have too much new credit on your profile. They don't like too much inquiries at all. I've seen it where if you applied, let's say you applied maybe 3 times in a month, and then you go like literally the next month to apply, they'll deny you because I think the lender is looking at it. Well, how much credit you want? It's good to have credit and it's good to have opportunities and options, but at the end of the day, can you pay all those credit back? Can you pay all those cards back? Can you afford those loans back? You understand? So this is the reason why they keep asking you, like, how much you make, and what credit card you and how much inquiries. But like anything else, and this is something for like a different life. Your credit is something that can be fixed. It can be fixed. It can be cleaned up. It can be taken care of. You can definitely do it. And that's a different video of how to basically clean up your credit. Now, if you check out my channel, I have videos on there that talks about, the things that bureaus look for when you write to them to try to clean up your credit. I talked about how to clean up your credit with the snail mail way as opposed to the digital way. So if you get a chance, check out the channel. I have these videos. This credit, this is basically a series that I'm doing because what Team U talks about, what this channel, what I really focus on is ways to level up your money. And I realize, just even based on the comments that I get, that a lot of people literally don't know about credit. And I'm not talking about like knowing of the existence of credit cards. I'm not talking about knowing of the existence of just borrowing money. I'm talking about a lot of people don't understand and don't know how to use or how to utilize the tool of credit. They don't know how to use it. They don't know how to go out and get credit. They don't know when they default. They don't know the rules of credit. They don't know the game of credit. And the funny thing is, you don't even need to make a lot of money to have good credit. You don't. You have people that have credit scores that are 700, 800, okay? Anywhere from 650 up, that don't make a lot of money, but they're able to buy things because, see, the trick is that good credit allows you to buy almost anything you want. Because you could still make a decent salary or a lower salary and have better credit than somebody who makes more than you. Because you make less and you manage your money better than the person that makes more. Because the person that makes more doesn't know how to manage their money. That's what credit is. Credit is managing your money. That's what credit is. Okay? And if you know how to manage your money, it's very easy for you to qualify. It's easy for lenders to lend you money. See, what you don't understand is that banks are in the habit, or banks are in the business of lending money. They want to lend money. It's just as hard for the banks to find people. Just as it's hard for some people to establish credit and to try to find credit, it is just as hard for the banks to try to give credit. Because again, a lot of people don't have a payment history. A lot of people don't know how to utilize their credit. They don't know how to utilize the amount. A lot of people don't realize that you have to have credit ongoing. You got to show the lender that you know how to manage your money. Okay? I have credit cards on my account that are like over literally 17 years old. I'm not even kidding you. And I'm in my 40s. 17 years old. I've had the same credit card. Another trick that a lot of people do with credit cards, like let's say you have a credit card for a long time and you don't want to, keep spending, because I know it's tempting. You might want to use it even if after you pay it off, maybe use, your return, whatever, to pay your credit card off. You don't want to go back in that trap again. But some people literally just put them away. Or some people end up, I had one girl tell me that sometimes she just, she has a card for a long time. You never close it. She doesn't close it. She literally just, like she says, she cuts them up. I don't cut my cards up. I just literally put my cards away and I leave it there, because there's times when I do need to use a card that I even forgot about. Okay? A lot of people end up, that's another thing that I want to advise that you never do. If you have a credit card that you've had for years and, you've paid it off and you don't want to be tempted to use it again, don't ever get rid of that card. Okay? You don't get rid of it, because the longer you keep it, it's the more it's reporting, making up your payment history. So again, I always use 1,000 because that's, like, I guess that's my favorite amount. Let's say you have a credit card that you owed $1,000 on, right? And you paid off the 1,000. Let's say the limit was 1,000. You paid off the 1,000 limit and you have that card. This is fabulous, because now that card that you have paid off, that card is now being reported to the bureaus. So it's showing. So what you want to do is, when you have that card that you paid off for that 1,000, every once in a while, maybe once a month or once every 2 months, you want to get a cup of coffee or buy your gas or whatever it is, buy yourself an ice cream, whatever it is, but just use the card. Because another thing with credit cards is that if you, let's say you pay off a card, or even if it's a new card that you never use, and even though it's open and you could use it, and if the lender sees that you're not using the card, they're going to close it. So another trick is that when you have or you establish credit, you still have to use the credit card. You still have to use it. You don't just leave it open like that. You get what I'm saying? You still have to use it, because you have to show an activity. It's like the banks don't want the card being dormant where it's not being used. You're just having it there. So again, it shows how you're utilizing it. Credit utilization is number one. All right, that's the way you manage your card. Okay, and then once you do it, by the time you look, you have 1, 2, 3, 4, 5, a lot of cards, as much as you want. Then after showing that you have a good, payment history, or you have, accounts for a long time, you're going to start getting offers. You're going to start having banks that are sending you multiple cards. And I always tell people, be careful with that. Yes, I believe in having more than one credit card. Yes, I think it's important to have more than one option. Options in life is good, but you don't want it to be where you're utilizing every single card, or you're having like 20, 30 cards, because again, lenders don't like too much inquiries, and lenders don't like too much accounts on one profile. It looks like you're desperate for credit, like you want too much. And it's sometimes too much credit is not good. You want to have a decent amount where if you jam or bind, you could always borrow. I also want to touch on something else. I want to talk about, when you're applying for credit, right? And this is the last one, new credit, okay? And I want to talk about, like, when they basically pull it. Every time when they pull your credit, right, it's called a soft pull and a hard pull. So the soft pull, they say the soft pull doesn't affect you. It doesn't show, because remember, every time when they pull your credit, your score goes down. Even if you're applying, if it's even like 10 points, your score goes down. So again, this is why you don't want to have too much people running your credit. You don't want to have too much inquiries on your credit, because it just keeps dwindling down or tanking your score. Right. So what you basically need to do is this. Whenever you apply for new credit, right? Whenever you apply for new credit, the inquiries, you got to basically space out the time that you apply for credit. You don't want to keep applying for credit back to back. It's too many inquiries on there. And you want to make sure that whoever's pulling your credit, that they're doing a soft pull on your credit. You want it to be a soft pull. Now, most lenders, what they will do, and I think this is actually good. Well, this is actually pretty good, because again, every time they pull your credit, it could go down. Some of them do a soft pull, and if they end up doing a soft pull, it tells them exactly what your score is, right? Tells them what your score is. And in addition to them know what your score is, if they believe that you're pre-qualified, then they do the hard pull. They do the hard pull. And with the hard pull now, that's the one that's going to actually, and either way, your score is going to go down a little bit. But it's not to the point, it's not going to go down to the point, you're not going to lose 100 points because of of an inquiry or a qualification for something. You only really lose a lot of points, like, when it comes to like your payment history, like if you haven't paid on time, like if your payments are late. And it's crazy. It's amazing because you can have such a really high score. You can have like a good, I'm just throwing a number out here. Like, let's say you have like a 700 credit score, and the one late payment that you have could literally send your credit score like to like down to like 600. Or I'm just giving a round number. I don't know exactly what numbers. Everybody's score, everybody's financial situation is different. But one late payment could basically like send your payment down so low. And you don't want that. If you've been working like this literally this whole year, or how many years trying to build a credit for that big purchase, because the question is, why do people even build up their credit? Why do people try to have good credit? Ultimately because you want financial freedom, you want to buy something. A lot of people basically look at their credit when they want to buy their cars or they want to buy their homes, because I think those are the two major purchases that people really utilize credit for: cars and homes. More so, what I touched on yesterday was, that mortgage. That mortgage is like the biggest thing, with credit. It's the biggest thing with credit. It's like there's no way you're gonna qualify for a mortgage if you don't have decent credit or somewhat up to par with your credit. They're not gonna give you the money. And with everything, okay, if you're buying the car, and your credit isn't good, yes, you don't have as much strenuous documents or paperwork, but here's the thing: you end up getting higher interest rates. You don't want that. Yes, you're gonna get the instant satisfaction of having the car, but sorry, you're gonna have the instant satisfaction of getting the car, and you feel really good and you drive off, but at the end of the day, the interest rate is so terrible. You're gonna have a hard time paying for that car. It's like that instant gratification is gonna end up, being long-term dissatisfaction. You're gonna probably have buyer's remorse, for that car. So you want to make sure that you go into that dealership the right way. As I said, the mortgage is a very big asset. The house is a big asset. The purchase is very big. So if you end up paying, or getting a really bad interest rate, I had a gentleman touch on the adjustable mortgage yesterday, and it's some people where they qualify where you might get it low right now, and later if it's adjustable, it might go up a higher rate and it changes your mortgage payment and all those things. Again, you want something that's fixed, right? Just like with them credit cards. That's why you want to make sure you make the payments right away, because you don't want to extend it, because the interest on it over time is just too much. It's like $1,000 credit should not cost you, $3,000-$4,000 in the end by the time you pay that card off. Credit is something that is good. I think credit is wonderful, in my own personal opinion. I think everybody needs credit, but with credit, if you don't know how to manage and how to utilize your credit, it's going to be very difficult. It's going to be difficult for you to buy anything. It's going to be difficult for you to, establish, your profile. So those are, those were the five things, and I named them the big five. So again, just to touch, let me just tell you exactly what they are. If somebody that's just joining us new, as I said, it's your payment history. That's 35%. It's your credit utilization. That's 30%. It's the length, the time that you've had credit. That's 15%. It's also the mix, which is 10%, showing how many, how many different lines or how many types of credit you have on there. And it's also the new credit, which is 10%. You notice that they're not really big on the new credit. The hardest part is establishing the credit. And once you know how to establish the credit, okay, so I think it's Alkaline said, would it be smarter to get credit through an LLC if you have bad credit from over 8 years ago and start to fix it? Okay, so Alkaline, I think you're talking about like business credit. Business credit is like a whole different thing. I mean, I know about business credit too, but business credit is like a whole different thing, because with business credit, it really goes through your LLC and so forth. It's not really counted towards it. Like I know, for example, like let's say you open a business and you're able to get a business credit card, right? They don't really ask you for a personal guarantee depending on how much money you're taking out. And business credit is something that is basically separated from personal credit. But the thing with business credit is that you know that business credit, like you qualify for business credit based on your personal credit. Of course, there's places that say, yeah, they could give you that whatever, but trust me, for you to start establishing business credit, you have to have some type of credibility with your regular personal credit to get business credit. And then once you get business credit, I remember a couple years ago, Sam's Club, I'm not even sure if they do it anymore. Sam's Club offered a business credit card, and people are saying, oh, that you could qualify for it, with your personal credit. Hogwash, absolute nonsense. Try to get it, and literally the person that was taking the application, they was like, yes, it is a business line of credit that's reported to like Dun and Bradstreet, whatever this, that, and the third. But it all depends on your personal credit, right? How you're managing your money eventually, because they have to have some type of criteria. So your question, of course, right, of course, if it makes it your personal credit, of course, because you separate your business, right? And we separate our business because of tax purposes. Now, your question is it better to fix the credit? For me, I would fix my personal credit because, again, as I said, it's called something PG, personal guarantee. Even when you apply for business credit, you still, they still look at some things of your personal asset, your personal credit, right? And for personal credit, I mean, it's something that you could easily fix yourself. You could easily fix yourself. Many years ago, when people used to try to get credit, it was so hard. It was so hard for people to get credit. Okay? It was hard. But now, like I said before, with this technology age, like these banks are dying to give people money. I think, what is it? Chase had a program. I mean, I didn't apply for it, but Chase had a program where if your FICO was 700, you could literally get like hundreds of thousands of dollars from Chase. Now, look into that. How much people not that you know people's personal profile, but how many people that's trying to start a business that have over a 700 credit score? So yes, they offer it to you, but the question is, can you qualify for it? So this is why I would say, yes, business credit is wonderful. I love business credit and so forth. I've had business credit cards. The good thing with business credit cards is that the difference with business credit card is that you don't have to stay under 30% utilization, right? You might get a business credit card. Like, let's say you have the Amex business credit card. You could spend, if it's 10,000, you could spend the whole 10,000, but just know that next month you have to be paying the whole thing back, just like with their personal credit card. So it's like some of them might give you, some more leeway. The business credit card might give you more leeway, but it's like the more you can spend, it's easier for you to get into more, like, I don't know, financial trouble. I don't know. But there's nothing wrong with having a business credit card. So I would definitely, yes, I would get business credit if I could through my LLC. That's right. And I remember a couple years ago, people to get business credit, they was using stuff like Granger. They were using those accounts where, like, if you order like stationery and it was reporting, and then people was having Dun and Bradstreet. I mean, it was so much harder. Honestly, I mean, I haven't even touched on getting business credit in a few years, to be quite honest. I mean, I know about it. I know how to get it. I know how to qualify for it. I know that even having just like a regular PayPal account, if you take PayPal, you can easily get like business funding through PayPal. But again, having business funding or having business credit is wonderful, as long as you know that you still have your personal credits that's decent. And as I said before, it's not really hard to clean up your personal credit. It really isn't. And I've had times where my credit wasn't up to par, and I do it myself. And I don't know, maybe I'll start running a workshop, where I start teaching people how to clean up their credit. Hi, Banner. Good to see you. How are you? Good to see you. Today we're talking about the big five and, all the things that we need to clean up our credit. Right. And I talked about payment history. I talked about utilization. I talked about the length of the credit history, the mix of credit, and finally new credit. So just had a gentleman in here asking, what's good with you, better business or regular credit? And I said, business credit is great, but I will always work on my personal credit. Sometimes, if you have a business, stuff happens, life happens. But that freedom that you have with your personal credit is timeless. It's like you're never going to get rid of your personal credit. You always have it. You need it for life. Businesses come and go. People open businesses for years and close businesses. But your credit profile, even when you're retired, even when you stop working, keep you still utilizing your credit. If you have a business and you close a business, you don't use that business credit anymore. Right, because whoever's funding the credit, you have to show them that, you know, I'm saying you said all SIM this back to how to be used. I'm not really sure what you're saying. Like, what do you mean, like a SIM card? I'm not sure. Right, just re-put your question there, just to make sure. Credits. Okay, you're saying that all credit is the same. It's just how you use it. You're right, right. Well, what's credit, right? Credit is borrowed money, right? And yep, credit cards. Yep, that's credit. Whether it's auto credit, mortgage credit, credit card credit, doesn't matter. It's borrowed money. And when people borrow you or lend you money, they just want to make sure that they're gonna get their money back. That's all. So again, this has to do with your utilization and your payment history, how you're paying people their money back. That's all they want to know is how you're paying it back. If you're not paying the money back, I mean, that's it. That's a wrap. You're not going to be able to qualify if you default. So like I said, I think credit is good. Credit is a great tool, but just know how to use it wisely. For those of you that came on the live tonight, I really thank you for your time. If you haven't subscribed to the channel, please subscribe. Again, I'll be picking this back up tomorrow. I'm going to have another workshop on credit. The name of this live was Credit 101. And these were the basics. These are the 5 components of your credit report. The 5 percentages of what makes up your credit report. So with that said, have a wonderful, wonderful evening and so forth. Thank you so much, Bander. Thank you for liking. Thank you for supporting the live. With that said, I'm sure I'll be on tomorrow. Please join me again where we talk about credit. All right? So we've talked about credit in real estate. We've talked about and tonight was the basics of what makes up your credit profile, because I don't think a lot of people understand what makes up their credit profile. They don't understand. They don't know. And because they don't understand and because they don't know what makes up their credit profile, it makes it very difficult for them to even get credit. And we want to change that. I always tell people on my channel, I say, we want to level up our money. And one of the first ways to level up our money is to clean up or level up our credit. Once your credit is good, you can buy whatever you want. You might as well call yourself a millionaire once you have good credit, because you basically open a gateway to getting the things that you need. Okay? And with that said, thank you so much for joining me, team. Have a wonderful, wonderful evening. All right. Thank you so much. Mander, thank you for joining. I appreciate it. All right. Alkaline, thank you so much for joining on the live. Appreciate your time. Cool Kid, thank you. Omid, thank you for joining. Have a wonderful, wonderful day. Okay. Bye. Thank you. Yes, you're welcome too.